Well, our next guest says today's bounce may not bounce into the new year. Let's bring in Chris Harvey, head of equity strategy at Wells Fargo Securities. Chris, good to see you.
Good to see you.
What do we mean when we say that?
So what I mean is our price target is 30.88. We're about 1% away from that. At this point, what's the risk reward? What kind of upside are you seeing? What kind of downside are you seeing? You're seeing a limited upside and a growing amount of downside. But more importantly, as we look forward, you've squeezed a lot of juice out of this trade. The 10-year's at 1.7, 1.8. Investment-grade credit spreads are 100 and 110 basis points. You tack on a healthy 3% risk premium, and you're looking at mid-single digits for the next 1, 2, 3 years. At this point, I keep hearing my father's voice saying in the back of my head, don't screw it up, right? You're up 20%.
They have medication for that.
Did you do that a lot, Chris? Was that an issue for you growing up?
A lot of therapy. Years of therapy.
I don't even want to know, all right?
What's the biggest positive that's on the horizon for the market then?
Biggest positive. We've been looking more at the negatives than the positives because the positives have been the Fed's going to cut rates. They cut rates. Fed is sentiment's really poor. Now the sentiment's rather positive. Sentiment is trade and tariff needs to get done. Well, it looks like it's going to be 5 minutes, so it could be 5 minutes, could be 5 days, could be 5 months. And so we're looking at the negatives. The negatives are 401ks. You look at my dad, you look at my mom, they have to take money out of their 401ks. If you look at the Fed, at some point, this QE, not QE, is going to end. We'll have less liquidity in the beginning of next year. And more importantly, I think that people's expectations for growth are just too high at this point in time. And we need to ratchet things down. And we haven't even talked about the political risk at this point.
Chris, I've asked this question before, but I'll ask it again. I mean, the U.S. equity market, Pete mentioned the VIX went to 17 yesterday, but it's meandering around 14 forever. Bond market, 10-year yields, I mean, that sucker moves major way. I mean, if that were the equity market, we'd talk about it every single day based on the volatility. I mean, we have 10 basis points moves almost on seemingly a daily basis. Is that concerning at all?
That is highly concerning. If we see 1.5 in the 10-year, I think risk aversion comes back to the 4. And you're right. We were looking at this the other day. You're having 10 basis point move every day. That tells you the market's really, really jittery. At some point in time, if you see that catch a very strong bid, it's going to be hard to price risk risk assets higher. So we continue to watch that day in and day out.
Yeah, but the problem is you went off on a litany of things that are negative on the market, and the market has ate them up, spit them out. So I do hear it's all about estimates for me.
Right.
So wherever earnings estimates are, Q1 is where the market's going to go. Do you feel like they're too high for Q1?
For Q1, that's a tough one because we're bringing down fourth quarter estimates. I think for all of 2020, estimates are still too high. I think you're looking at 0 to 5% growth for next year, and people are up in the high single digits at this point in time. So they do have to come down.
So your 12-month target, if you publish one?
We're pacing ourselves at this point in time. So we'll be putting one out very shortly.
But do you see a down year next year?
We don't see a down year, but we don't see a whole lot of great opportunity to the upside at this point in time. Next year is going to be a year you really want to trade and you want to trade your book. The opportunity is going to open and close rather quickly. We're going to have a lot of spikes in volatility. The decay will be pretty fast, but a lot of opportunities will open up.
Is there a sector right now that you're looking at where you say, you know what, it's moved, but I still think they have more room to run? Is it the financials, or where is it that you'd say right now I'd be looking with less risk on, but I still have risk in the market?
That's a great question, great point. So we upgraded banks back in September. They've run. They're up 35%. We would love to see them pull back, and if they do, we would jump back in. So financials are a place that we really want to put money to work longer term.
Guys, really quick, because you started this with the context of, we have no growth or growth is not going to be that great. What does that mean? Put a number on that, at least in the what's your chief economist say? What does bad growth mean?
So bad growth, it's not bad growth, it's just not great growth. So globally, I think they're looking for 3.2. What we're looking for is in the 2s domestically, and what I'm looking for EPS is 0 to 5%. So it's not negative, it's just not great. And how do you price multiples higher after you brought rates down, after you brought credit spreads down, after you had the Fed cutting rates, and after we priced in so much good news around trade and tariff? Once we get phase 1 done, I don't think we have phase 2 for at least 12 months, if we ever do.
Market knows that, though, right? Market understands that. No?
I think so.
Well, again, look at what we've seen over the last couple of days. Like, phase 1 is done, it's done, it's done. It's not done, right? So market pulls back. We may not get phase 1 done until March. And now the question is, and somebody said this earlier, is what are the expectations? Is phase 1 going to come in line, or is it going to beat expectations or less? It's going to be hard for phase 1 to beat expectations at this juncture.
Chris, thanks. Good to see you.
Thank you.
Appreciate that. Well, with that, I mean, you can't say sentiment's getting toppy, right? The more you hear narratives like that.
So I was of the mindset that once we get a trade deal done, it was the top of the market, you could sell it. What screwed me up is when they said we're going to divide it up into phases, because now they pushed you out to when you could sell into that sell the news event. I think we are going to see estimates dictate direction. So wherever the estimates are, that's where you're going to go. But I believe from now to the end of the year, the markets will move higher, 32.50.
Tim?
So I don't want to put too much pressure on Chris, and Chris is not a chief economist. So, I mean, when we talk about growth, but if the U.S. economy grows at 2%, this market is cheap. At 1.7 long-term rates and rates where the Fed is going. I think what has worked has been this barbell of discretionary and kind of the high-growth names and then go for value. Some of the industrial names, if we're growing at 2% into next year, and I think it's actually more like, 1 to 1.5 to 1 3/4, but I think you've got that dynamic. And remember also the breadth of this rally has been in every corner of it. And I think that's what supported this market. And I think you have to be fearful of that leaving you soon.
Yeah, and I still think the president's the wild card. I think he feels, and he has said this, that he has equity to play with in terms of the stock market, given the rally. I think he'll use that equity over the next month or so. I think in his mind, he says himself, in the spring, this is when I'm going to get this thing on course. That's when elections are won. So I think from now to then, it can be dicey. I still think the VIX at wherever we close today is way too cheap given all the risks that are out there.
And we've got incredible volumes in the derivatives market. And just Chris's point, last thing, financials. Even with this run, Carl, they're cheap and there's still potential there for much higher levels.